Financial markets are where individuals and organizations trade assets such as bonds, currencies, and other securities. Participation in the financial markets is a way for institutions to generate funds that can be loaned to borrowers. There are two different kinds of financial markets: money markets and capital markets. Money markets trade in short-term securities. In this case, short-term means the majority of the securities traded have a lifetime of less than a year. In fact, assets traded in money markets can mature in periods as short as 1 day. Securities traded through money markets can include negotiable certificates of deposit, Treasury bills, bankers' acceptances, bills of exchange, federal funds, and short-term mortgage-backed securities. Money markets are usually used to raise funds for immediate needs or to provide a safer short-term investment. A disadvantage of trading through money markets is the returns on these kinds of securities are lower than on longer-term ones. Capital markets are where long-term debt and equity securities are traded. Savings and investments are channeled through these markets from investors who supply capital to businesses, governments, and individuals. One defining feature of capital markets is that they're utilized to meet longer-term financial needs. There are also two kinds of capital markets. Primary markets create and initially exchange securities. In a primary market, investment products are purchased directly from the financial institutions originating them. An example of a primary market exchange would be the purchase of a company's stock during an initial public offering. If financing for a real estate transaction is acquired through the primary market, it means the loan is acquired directly from a financial institution like a bank. Secondary markets are where investment products are exchanged between investors. The stock market and stock exchanges are principal elements of the secondary capital markets. When investment products are traded in person at a central location, the investment products are said to be exchanged through an auction market. But they don't have to be traded this way. If exchanges occur through a telephone or internet, for example, trades are said to be carried out through the dealer market. Oftentimes, loans are sold by the issuing financial institution to other institutions or to investing parties. The third-party financial institutions or investors can bundle together multiple loans into a complicated investment called a mortgage-backed security, or MBS. Shares of the MBS are then sold to investors. Because of the secondary market trades, actual ownership of a borrower's loan may be very different from the institution that originally issued it. There are several government-backed organizations that participate in the secondary markets. The Federal National Mortgage Association, better known as Fannie Mae, is a privately owned, publicly traded, government-sponsored agency that operates under a congressional charter. Fannie Mae's purpose is to expand the secondary market and increase the availability and affordability of funding for home purchases. Fannie Mae was established in 1938 with the aim of providing federal money to local banks in order to finance home mortgages and, by extension, increase the level of home ownership. Fannie Mae was made into a fully private corporation in 1968, and in 1970 was given the authority to purchase mortgages not insured by a government agency. Fannie Mae primarily purchases loans, especially mortgages, that meet certain qualifications. These are called conforming loans, which are bundled into mortgage-backed securities that can then be sold to investors through the secondary market. These securities are backed by the organization, which makes them an attractive investment. Ultimately, Fannie Mae's actions provide fresh money for lending to financial institutions. They also create flexibility and liquidity in the American housing and credit markets. The Federal Home Loan Mortgage Corporation, more commonly known as Freddie Mac, is another privately owned and operated government-sponsored agency that operates under a congressional charter. Freddie Mac was established in 1970 with the purpose of providing competition for Fannie Mae. This bolstered attempts to increase the availability of funding for home ownership. Freddie Mac is run by an 18-member board of directors subject to oversight by the Department of Housing and Urban Development, or HUD. Freddie Mac carries out activities nearly identical to Fannie Mae. They purchase conforming loans and resell them as parts of mortgage-backed securities guaranteed by the organization. The main difference between the two is that Fannie Mae mostly buys mortgage loans from commercial banks, while Freddie Mac mostly buys them from smaller banks, often called thrift banks. The Government National Mortgage Association, or Ginnie Mae, is a government-owned and operated corporation administered as part of HUD. Originally part of Fannie Mae, Ginnie Mae became an independent organization in 1968 when Fannie Mae was reorganized. Unlike Fannie Mae and Freddie Mac, Ginnie Mae doesn't originate, purchase, or sell securities of any kind. Instead, it guarantees timely payment of principal and interest amounts for mortgage-backed securities made up of government-insured loans, including FHA loans and VA-backed loans. The way this works is that private organizations approved by Ginnie Mae originate and bundle government-backed loans into securities. The securities are then issued as mortgage-backed securities that carry a Ginnie Mae guarantee. A guarantee made by Ginnie Mae is backed by the federal government. Financial markets are a key part of the American economy. As we've noted, the primary capital market is a place where mortgage loans come from. The buying and selling of loans in the secondary capital markets, whether individual or packaged into mortgage-backed securities, generate money for financial institutions. That money can then be passed out in the form of new mortgage loans.